Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our July 2026 update, Single Manager Risk Flares Up on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. So actually, Andrew, I had a hard time deciding on a title for this month because there was so much that happened and the options were all good. But I thought, let's go with the single manager risk one because that's really been showing up this year. And it's one of the many things that DBMF seeks to solve for with its replication approach. So there's the embedded plug to kick us off. Onto the update. Over to you.
Thanks, Mike. So we gained around 1% in July and are up more than 11% year to date. We're up around 28% year over year. Year to date, we're around 300 basis points ahead of both the SocGen CTA index and the Morningstar US Trend systematic category. All good. Now, these markets are not for the faint of heart. This month, as we note in the first bullet point, headlines were dominated by the resumption of a hot war with Iran, a rise in oil, a hawkish shift in the new war Fed, and of course, violent price moves in both AI and AI adjacent stocks. In that context, it's been fascinating to see CTAs straddle dual competing narratives. On the one hand, risk off positioning around higher crude and higher rates, on the other hand, long equities. For the past several months, that hedged positioning has insulated the portfolio from some of the more dramatic moves you've seen across equities, crude oil, and other markets. The last bullet point is about single manager risk. While everyone was watching situational awareness semi-implode, in CTA land, a few funds were caught in these market whipsaws, leading the space to underperform by an unusually large 200 basis points using the SocGen CTA index as the benchmark. If any allocator out there hasn't learned that you don't get paid to take single manager risk in CTA land, it's time to study up. Here's a line of our year-to-date performance through July. The dashed blue line is DBMF, the pink is SocGen CTA index, and aqua is the Morningstar systematic trend category. At the bottom is the Bloomberg Ag Bond Index. On a relative basis, it's been a fascinating year. We had strong outperformance early on due to concentration in certain positions, e.g., gold and the yen, then gave it back after the war started, but fortunately owned crude, then tracked very closely until the past few months when we started to pull ahead again. Now, my general conclusion is that trading hundreds of positions, short-term models, tight risk management, and other features simply don't add enough value to warrant the higher implementation costs and complexity, and I think we see that in performance so far this year. Now, over a longer period of time, here's our updated performance since inception, where we've outperformed the flagship hedge funds in the SGCT index by nearly 400 basis points per annum and more than doubled the performance of the Morningstar peer group. Now, I'll make one point on this. A criticism of our replication process has been that utilizing only 10 major contracts would systematically underperform in this brave new world of higher rates, less coordinated monetary policy, and geopolitical chaos. In fact, the period since then has been among the strongest for our strategy relative to the target hedge funds. So I think it's time to rethink some of those assumptions. Here's our slide on volatility adjusted positioning. The green bars represent exposure of our 10 futures contracts at the end of July, and the red dots are positioning at the end of June. The changes during the month were relatively modest, but I'd like to highlight something I mentioned early. There are times when the whole portfolio seems geared to a single macro trade. Now, this is not one of those times. Long crude and short treasuries clearly should help if inflation spikes due to hostilities in the Middle East, whereas the long equity position benefits from the AI economic supernova. The long dollar position potentially works in either scenario. So as noted, this dual theme positioning has protected the portfolio from some of the violent price moves we've seen across markets over the past several months. Now, to underscore this point, here is contribution for July. We generated strong gains from our long position in crude oil and short positions in treasuries, but we're on the wrong end of the Bank of Japan's and apparently the US Treasury's intervention in currency markets to stem the drop in the yen. While with EM down substantially, South Korea's Icarus-like equity market was down close to 20%. We gave back some gains there. But overall, fortunately, we ended up for the month. And to zoom out, here's our year-to-date contribution to performance. The moneymakers this year have been oil and emerging markets, and we basically tread water across other asset classes. But early contrarian and right positioning in those markets has been enough to deliver 11% plus returns during the first 7 months of the year. And with that, back to you, Mike.
Okay, thanks, Andrew. Excellent. So let's wrap up here with long-term performance numbers for DBMF. Annualized return since inception, including the month that was July 2026, is now 9.16%. That's nicely ahead of our major competitive benchmarks and far ahead of the traditional diversifier for equities, that in this case being bonds as represented by the Bloomberg Ag. And here is our executive summary slate, an overview of DBMF, starting with assets, 4.15 billion as of the end of July. That's the largest in the Morningstar systematic trend category, with a track record over 7 years. The 9% plus annualized return since inception comes with less than zero correlation to stocks and bonds for that matter as well. That results in over 700 basis points of alpha generating performance with an expense ratio of 0.85, which is in the bottom decile of the category. So thanks everyone for watching our monthly videos. If you have any suggestions in terms of things you'd like to see added, changes, feedback, or inputs, please let us know. Otherwise, if you have more questions about the strategy, would like further information or a call with us, please don't hesitate. Reach out, just send us an email at team@imgp.com.